Okay, folks, I'm going to start today with talking a little bit more about stories, a couple of very simple tests on storytelling and whether they're consistent. Now, hopefully this will help you as you construct your stories for your companies. I'll tell you up front, constructing a story is not easy, especially if it's the first time you've done it. So I'm not suggesting that there's an easy path there. But let's take a few examples. Let's suppose you're looking at somebody else's valuation of a company and you're just seeing the numbers. So I'm looking at one of your valuations. I see a compounded annual growth rate of 50% a year for the next 10 years in your revenues. I see an operating margin of 20% in year 10, twice as much as the average for the sector. And I see a cost of capital of 7%, which is below the market average. So those are the numbers I see in a spreadsheet. And you're now trying to reverse engineer what the story has to be for these numbers to make sense. So I'll list out the things with each one, and you tell me what you think the story is telling. First, do you think that this company is a small or a large company, given the numbers you say? Right now, I mean, if you put a 50% growth on a large company, so it must be a small company, right? That's the first thing to check. Is the total market stable or is it growing? Probably a growing market. It's very difficult to get 50% growth in a stable market and have your margins. It's a combination that makes it difficult to believe that this market is stable, but in a stable market, to grow, you often have to cut prices. So the fact that you're using this combination of high growth and high margins must mean that some of the market is giving you that advantage. Strong competitive advantages or weak ones? There has to be strong competitive advantages. And if you look at the return on capital that is being assumed and the reinvestment, it's a low number, the return on capital is a high number. What does it tell you about the capital intensity of the business? Now, they're investing a lot of capital to get this growth, not that much. Again, all you see is the numbers, right? You're trying to reverse engineer from the numbers. If you're a capital intensive business and you have this much growth, what should you expect to see? Huge reinvestments year after year. That'll show up as a lower return on capital. But the fact that the return on capital is high and the reinvestment is low suggests to me that it's got to be a light capital intensity business. That's coming from the numbers. And what's the nature of the product? Is it a discretionary product, non-discretionary? What's the input that kind of gives you insight on that? And the reason is? And also your cost of capital, right? If it's a discretionary business, remember the betas will be higher, the cost of capital will be higher. So sometimes people tell you, I don't tell stories, I just work with numbers. But that's a lie, right? The minute you give me numbers, you're telling an implicit story. And I then have to push back because if this is a manufacturing company, I'm going to say, well, why is your reinvestment so low? If it's a company in a mature market, the question I'm going to ask is, how can you grow so fast and keep your margins rising at the same time? If you don't have competitive advantages, I'm going to push back on the margin requirement. So what I would suggest as an exercise is pick up a DCF valuation that somebody's done. Reverse engineer from it what the story would need to be. Then look at the company and say, does this story make sense for this company? And as you do it, you're going to find yourself getting more and more comfortable linking numbers to stories. So every valuation, I'm sorry, you had a question on Zoom? So every valuation has an embedded story. So you value a company, you're done. May 8th, 9th, whatever the due date is, you turn in your valuation. What are the things that might cause that story to change? Let me list out the things and you tell me whether this could change. And some of the answers are obvious, but some might require a little. Earnings reports from the company, could they change your story? Absolutely, right? Most of the time they don't. Let's be quite clear. Most of the time earnings reports are incremental. You're finessing your story. But once in a while, companies surprise you. I have a blog post on how to read earnings report as an intrinsic value person, because when you look at earnings reports, people get focused on what's the earnings per share, what was the analyst expectation, did they beat or not beat the expectation? And sometimes you might be missing the bigger story. For instance, Netflix and Facebook on their earnings reports saw big drops in price this year, almost 20% drops. And that's hundreds of millions of dollars wiped out market cap. What was it in the Netflix story that caused it to happen? That the user numbers weren't growing like they used to, right? Could this have long-term implications? Yes. If your story is built on user numbers building up, you're saying, well, this is a negative surprise. But I'm surprised that people don't focus on content spending at Netflix and seeing what's happening. Because to me, that's a bigger part of the story. Is it decreasing as a percent of revenues? And if it is it decreasing by enough that Netflix can become a cash machine? The kinds of things you will look for in an earnings report, if you're a story person who's trying to do an intrinsic valuation, can be very different than what an analyst or a trader will look at, because the per share numbers are the least interesting part. To me, when I was early on when I valued Facebook, I came up with that it's like $35 a share. Until one earnings report, the value almost doubled. So what did you see in that earnings report? I don't know whether you remember, but when Facebook first went public, its mobile presence was awful. The original Facebook mobile app was terribly constructed. It froze, it didn't work. And that was a huge impediment because more and more online advertising was going through the mobile devices. And the assumption was Facebook will never get this. This is not the kind of platform that's good on an iPhone. Thank God Facebook didn't listen. And what showed that they changed was there was an earnings report where they showed the percentage of advertising that was coming through mobile. It went from single digits to like 35%. And basically that was the quarter that they cracked the code for making Facebook travel well to iPhones and iPads and Androids. And it made a huge difference in the valuation because it meant that Facebook, instead of being a Google wannabe, which is what I described them when they went public, was a company that could beat Google at their own game because it had a very different degree of intensity on the part of users. So when you're reading earnings reports for your company, what you're looking for is this something here that could change my story. What about macroeconomic changes? Could they affect your valuation? If you valued Sberbank 2 months ago, I heard the Russians were planning to open up the market today. I'd be interested to see who's trading today, right? I mean, that's going to be a scary environment to be trading in. But if you're valuing Sberbank now versus 2 months ago, would you get a different? Of course, you're going to get a different value. The world has changed under you. So when macroeconomic, whether it's interest rates or country risk or exchange rates, they can affect your value as well. Regulatory changes. That depends on your company, right? If your company is a company that's heavily regulated, changes in that regulation can make or break your company. What about earnings reports from other companies? Why would they change your story? Let's say you're valuing Facebook and Google comes out with a report that online advertising growth was strong last year. It's actually indirectly good news for you as long as it didn't come at the expense of Facebook. Sometimes what you learn by watching other companies' earnings reports can change your story for a company. The fact that Tesla's car production went up 30% and they're selling a lot more electric cars could push up your valuation of Rivian because you think that this is good news for electric cars, that gas prices are up, people are buying more electric cars. So the answer is all of the above, which means your story is in motion. You don't have the story forever. You have a story for the moment, and you've got to be willing to revisit that story. And I'll talk a little bit about how that can affect your valuations. And finally, as you know, I'm very fond of using corporate life cycles to describe companies, young companies, mature companies, old companies. And if valuation is a combination of stories and numbers, the question is, does that change as you go through the life cycle? If you're looking at that mix, and I'm going to read a couple of statements. The first statement, it shouldn't change. It should be stories and numbers for every company. Or it could be that the numbers matter more for mature companies and less stories matter more for growth companies, or maybe it's a reverse. What do you think happens to that mix of stories and numbers as companies go from young to old companies? Anybody valuing a young company here? Some of you might. Who are you valuing? And when you value the company, what's driving your valuation? It's all story mostly, right? And if you're a startup, an idea company, it's all story. As you get more mature as a company, that mix can change. So I'm going to use that framework as we go through. Share. So let's go back to where I left you off with the storytelling part. I talked about asking those three questions. Is it possible? Is it plausible? Is it probable? And here's a good exercise to make it better, right? Watch Shark Tank for a couple of episodes. And as the story is presented, ask yourself, what are the questions I would be asking this founder to get a sense of whether the story is possible, plausible, and probable? So with my Uber story, in 2014, I described them as an urban car service company that's going to attract new users into the business with local networking benefits and essentially the same business model. They don't own the cars and they don't hire the drivers. Not a very ambitious story, right? Because they were already succeeding on all of those fronts. So if you ask me, is that story possible? I could point to evidence here. They're already pulling it off. Pulling it off in what sense? It already were in, I think, 150 cities. In the Bay Area, which is where they have the longest history, they doubled the size of the car service business in the 5 years they were there. What does that mean? There are people in the Bay Area who are already not buying a car. They're saying, Uber's everywhere. I can just take an Uber wherever I need to. So in a sense, a story, because it was not ambitious, clearly passed the test. As a founder, and many of you I know are thinking about starting your own businesses, you're going to be tempted to tell big stories. Why? Because big stories attract big pricing. Big pricing means more capital comes in. My note of caution is the bigger your story gets, the more difficult it's going to become for you to defend that story. Because you got to come up with much more to show that this story is possible, plausible, and probable. I'll talk a little bit about the stories you can tell for Uber, which would require more defense, that it's a transportation company. It's a logistics company. But my story was narrower, easier to defend. Now, before we leave this part of the storytelling, I want to talk a little bit about some cases where you want a story to be true so much that you stop asking questions. I call these runaway stories. And let me explain what I mean by runaway stories. Usually in these stories, you've got a storyteller who's charismatic. You want the person to succeed. Second, they're telling a story about disrupting a business you've never liked. And third, along the way, they're telling you they're going to make the world a better place. Now, you want that story to be true, right? You like the storyteller. They're telling this big story about destroying a business you've never liked. And they're going to make the world a better place. When you want a story to be true, you stop asking questions. You buy into fairy tales. So I'll tell you a story. And you tell me whether you want the story to be true. It's about a 19-year-old who drops out of Stanford to start a business. You're saying, what's the big deal? Lots of tech geeks drop out of Stanford at 19 to start. No, this is a 19-year-old woman who drops out of Stanford. So already the story has a twist. And she's not starting a software business. She's starting a blood testing business. And none of us likes that business. If you ever had to make an appointment at Quest Labs, you know the torture involved in a blood test, right? You got to make the appointment 6 weeks in advance, show up an hour ahead of time. They keep you there for 3 hours, take 2 buckets of your blood, and then take 6 weeks to tell you what's wrong with you and charge you $1,500 for the privilege. So you want this business to be taken down. She's creating a blood testing business that will take 2 drops of your blood in a nanotainer, and in 45 minutes, give you results on 32 different blood tests. The whole thing is going to cost you less than $100, and she'll email you them. It's almost like she's in the 21st century. And along the way, here's what she's planning to do. She's planning to make these blood tests available to parts of the world where you couldn't afford blood tests. Think of all the millions of people who will now be saved. Come on, you want the story to be true, right? In fact, I wish I'd made up this story because it's a true story. It's, of course, the story of Elizabeth Holmes and Theranos. A blood testing company, true drops of blood, nanotain, 30. And to show you how much people wanted this story to be true, by the middle of 2015, Theranos was priced at $9 billion by venture capitalists. And some of the biggest names in the venture capital business were in Theranos. So in the middle of 2015, if you ask me, what do you think about Theranos as a company? I just said, you know what? VCs, very smart people, seem to think it's worth $9 billion, but that wasn't all. The Cleveland Clinic, one of America's premier healthcare institutions, had said, hey, Theranos looks good. We like the way they test blood. Walgreens was planning to add a Theranos lab in every single Walgreens. So the VCs had bought in, the Cleveland Clinic had put its imprint, and Walgreens was planning to use them. So in the middle of 2015, my assumption was there must be something here. There's something of promise. But if you're investing in a blood testing business, what's a one question that you would like asked and answered before you put money in? What's the question you would ask? Does the blood test work, right? This isn't some fuzzy business. This is a business of precision. I assumed somebody had asked that question, but I was wrong. Because in October of 2015, a Wall Street Journal reporter asked exactly this question. And you know what? The answer was in the public domain. Because if you're a blood testing company, you have to go to the FDA for approval. So he went to the FDA and said, well, on their website, Theranos claims that they've come up with this way of testing for 32 different things. How many of these have they been approved for? And the FDA said they've been approved for one. He said, why not the other 31? And the FDA said the results look a little noisy. You know what a noisy blood test looks like? Trust me, you don't want it. You go and you get your blood tested, the results come back, and the doctor says, you know what? You might be dying, or you might not. Come back in a few months and I'll let you know. And over the next 6 months, the entire company unraveled. The $9 billion went to zero. Theranos was cooking the books, making up tests. Elizabeth Holmes was banned from the blood testing business. She actually lives in San Diego, a few blocks away from me. I've actually seen her, but a few weeks ago, she was found guilty of wire fraud or whatever else. It shows you how long it takes for the legal system to catch up. But this business imploded and went to nothing. One question I did ask, because I did write a post in October of 2015. I asked two questions. One was in hindsight. Your response is, these stupid people. I would never have done that. And the first question I asked was, is that true? Would you have had the courage? In June of 2015, I remember Elizabeth Holmes came to New York to give a talk. There were thousands of people in the audience. People brought their daughters to the audience because they said, you want to see and she was one of the few self-made billionaires who'd built a business up from scratch. It was this young woman said, you know what, we're going to bring our daughters so they can see a success story play out. And my question is, would you have had the courage at that meeting to stand up and ask the question, does your blood test work? You'd have felt like the guy who shot Bambi, right? I mean, I've always wondered about that guy's psyche. You've ever seen Bambi? If you haven't, you should see it. It's the most painful moment ever in a Disney movie. Because you'd be killing a dream. It's not just a business story. And the other question I asked was, where was the board of directors while all of this was happening? It's a private company, but because it had venture capital, it had to have a board of directors. I said, why weren't they asking the question? So I took a look at the board of directors. And the answer was very simply right there in the last column. I mean, if you were creating a board, one way to create a board that will never ask you questions is pick a bunch of 80 to 90-year-olds, put them on the board, call for a board meeting, have pillows in front of each chair just in case they fall asleep. Perhaps an ambulance as backup. This is a board I mean, what is Henry Kissinger doing on a board of a blood testing company? He's probably asking questions about the Iron Curtain and what it means for blood, but he's not exactly the authority you look for. Of course, this is now a movie. It's great for movie makers, right? But this is a runaway story. I can see why people didn't ask questions, because it felt like a cat asking questions about making money when she's talking about changing the world. In fact, whenever you have a story built so much around a personality, like Theranos was, and the story is this big story, and nobody's asking questions, there's another side that often shows up. It's called a meltdown. And here's how the meltdown happens. You start by realizing that the storyteller that you admired so much is doing things that you don't quite like. So you start questioning. And remember, the story is built around the personality. And you realize the story they're telling is at war with the numbers. They're telling you a story, but the numbers don't seem to match up. Once the questioning starts, the story very quickly unravels. You get a meltdown. Now, of course, this played out again when WeWork went public, right? Again, a personality, Adam Newman. First company, perhaps, in the history of, I don't know, that was born out of a TED Talk. I mean, it was a TED Talk that Adam Newman gave 10 or 12 years ago about the importance of we as opposed to I, and that became WeWork. And when WeWork went public, it looked like it was going to be the next big thing, right? Because it came with pedigree. What was the pedigree? I mean, who was the biggest single venture capital investor in WeWork? SoftBank. And at the time, Masa Son was viewed as this visionary genius. And he'd invested $47 billion, invested on a pricing of $47 billion for WeWork. Goldman Sachs' initial pricing for WeWork was $90 billion. I remember when that pricing came out, somebody said, well, what did they base it on? Very simply, one thing, which is if Masa Son thinks this company is worth $47 billion, he's a smart guy, it must be worth more. The actual numbers were like kabuki dances, right? Basically, you wanted to come up with a higher number. But the initial expectation was it's going to go public, it's going to zoom through the roof, another great success. But I've never seen a meltdown happen that quickly as we saw with WeWork. Between the time that the prospectus came out and 6 weeks later, the pricing had completely melted down. They pulled the company off the market. You're saying, what happened? Adam Newman just got too greedy. If he just said, look, I'm going to wait and then I'm going to, I mean, if it had gone public, it'd been a $90 billion company, he'd have been worth billions. But he did petty things. You know that he charged WeWork for the word we? He claimed that that was his word. And because they were using it, like a few $100,000. It's like penny change given the value of the company. It was the first company. As I was reading the prospectus, I read a paragraph and I had to read it 5 times to make sure that I was actually reading it right. It talked about succession plans at the company. You know what was actually put into the prospectus as a succession plan at WeWork? That if Adam Newman ever got incapacitated, that Rebecca Newman, his wife, would be the person who did, what is this, royal dynasty? It was stupid because once when you do that and you make it front and center, people start noticing, what is this? And he also had the side business he was running where he was actually buying properties and renting them out to WeWork. Talk about conflicts of interest. 6 weeks later, of course, the pricing had dropped to really zero. The only reason SoftBank supplied them with capital and priced it at $8 billion is they didn't want to write off the whole thing at one go. But WeWork had a fundamental business problem. If any of you are in real estate, you could probably see what the problem is. How does WeWork work? What do? They go to the most expensive cities in the world. They usually get it's a high-priced building right in the heart of the city. They lease it out for 30 years or 20 years or 25 years. And then they sublease it if you're a customer for 3 months. That was their big selling pitch, right? You can get an office for 6 months. But historically in real estate, if you have a duration mismatch where you set up a 30-year lease and you sublease for 6 months or a year, that's been tried a dozen times in real estate over the last 100 years. As Sam Zell pointed out when we were good public, and every single time it's crashed and burned. You know why? Because all you need is one recession. And what are you going to have? You're going to have all your short-term clients leave. They're under no contractual obligation. You still have to keep making payments. So when WeWork described the business model, that was my basic problem. How do you deal with this duration mismatch? Again, I made the mistake of assuming they must have thought through this. Masa Son and Adam Newman are smart people. They must have thought through this. Somewhere in the prospectus, they're going to give me this magic way they have figured out to get rid of the duration mismatch. The prospectus, I think, was 300 pages long, and there wasn't one mention of the duration mismatch. Either they didn't even realize there was a duration mismatch, which terrifies me, or they realized there was a duration mismatch and they didn't care about bringing investors in and talk about what they were doing to deal with it. When you build a company or a business around a personality, you tell this big story, but you don't anchor the story in numbers. You might get a high pricing initially, but eventually the truth catches up with you. WeWork is also now a show on Apple TV. I think we crashed. It's like 6, what's the first 4? It's actually, you can't stop watching these shows. It's like watching a car wreck happening. No. But basically, you can see in these cases what happens when people overreach and how long they can get away with overreaching before it catches up with them. One more twist. Now, let's say you're looking at a big market. What kind of big market? It could be cloud. Right now, cloud business is huge. Electric cars, everybody accepts it's going to be a big market. When you have a big market that's nascent, when it's just starting up, you have the potential, at least, for what's called a big market delusion. Let me explain. Let's say you see a big market. It could be cloud, it can be China, it can be electric cars. You're a founder. When you see a big market, your eyes light up, right? So I can make money on that market. You start a business. Now, before we go any further, when you look at entrepreneurs and you think in terms of confidence, do entrepreneurs tend to be kind of overconfident people or kind of underconfident people? What leads you to become an entrepreneur? What kind of personality do you have to have? You almost have to be overconfident, right? You got to assume you can conquer the world. And it's great that you have that. So you're an overconfident entrepreneur. You found this big market. You start a new business. You approach venture capitalists. Venture capitalists, do they tend to be kind of shy people or overconfident people? Venture capitalists think they can pick winners. So you're an overconfident entrepreneur. You see a big market. You create a business to take advantage of the big market. You find a few venture capitalists who buy into your vision. They're overconfident people as well. So you now have this little nest of overconfident people talking to each other. When I ask you to value your company, what do? You're overconfident. You overestimate your chance of success. You overestimate revenues. And all your venture capitalists, because they bought into that vision, all go along. You come up with a value for your company. But remember, this is a big market. There are 100 little clusters just like yours all across Silicon Valley doing exactly the same thing. If I take the valuations at each of these clusters and add them all up, what am I going to end up with? Too much of a value, right? It's a big market delusion, and it happens. It happens every single time. I remember the first time it happened in my lifetime was in the 1980s when the PC business was viewed as this big market, and it was right. The PC business, at that time people were buying PCs for the first time. Huge growth business. All these companies got priced high because they were in the PC business. At the end of the decade, you look back, there are only 2 PC companies that actually came out of the wreckage with any value, Compaq and Dell. Every other PC company crashed and burned. You go to the 1990s, you get the e-commerce business, the online commerce.com companies, hundreds of them, all with visions of sugar plums and big markets coming in. And you look in 2001 and the wreckage, there's probably Amazon.com and 2 other companies. The thing about these big markets is the winners might end up getting these huge valuations, but there are going to be a lot of companies that crash and burn. And collectively, you're almost always going to get an overvaluation. What does that mean? There's going to be a bubble bursting, right? Whether it was 2001, the dot-com bubble, the late 80s with PC company bubbles. In fact, one thing I did when I first wrote this piece on my blog about big market delusions is I took every company that makes money on online advertising that was publicly traded. And I played a little game. I said, I know what the market cap of the company is. I'm going to back out from the market cap what the revenues would need to be 10 years from now to justify the market cap today. You can do that even within your spreadsheet. You can solve for the revenue growth. I solved that for every company. So I got the expected revenues. Then I added up all of those revenues. And I came up with a total value for the revenues that actually exceeded this. It was double the size of the actual advertising market. In other words, people were building in the expectation that all these companies would succeed. And you added up all those expectations, you say, this can't happen. Same thing is playing out in the electric car business right now, right? Let's start with the assumption electric cars are good. We're going to have a big market. If you take the market cap of Tesla alone, Tesla will have to sell about 20 to 25 million cars to break even. At the existing market cap, close to 30 million cars. In a typical year, globally, 80 million cars get sold. So let's take a best case scenario. If you're an electric car believer, that every single car sold 10 years from now is going to be an electric car. And don't even get me started on automated driving, because that might change that market entirely. You see why? Because if there's true automated driving, we don't need 80 million cars, right? Why not? Just walk out, look on the street. You're going to see all these cars parked on the street. Think of the incredible wasted capacity. You don't need that with automated driving. So let's take that out of the picture, because sometimes people throw that in as a good thing. 80 million cars, every car is an electric car. Tesla alone has to sell 25 to 30 million to justify its market price. Then take Rivian and Neo, and that's just the existing players. There are other players lined up to go into it, and ask yourself, how do you get to the market caps of all of these companies? Doesn't mean you sell short in every electric car company, because the winner can still be like Amazon.com, a huge winner. But collectively, these companies can't justify the pricing. It's a big market delusion. It happens every single time there's a big market. So what's the electric car business? What's the cloud business? And this is where I think you get the flaw of Cathie Wood, right? Cathie Wood, and look at ARK and look at how she invests. She invests on big markets, every single company. If you push beyond the surface, why are you owning Shopify? Because it's a big market out there for this, for bringing technology to retail. Why are you investing in Tesla? Because electric cars is going to be a big market. Why DocuSign? Because everybody's going to be doing their contracts online. And the macro story makes sense. I agree with her on every single macro story. The question is, why this company, even if the macro story is right? That's what storytelling does. It forces you to think about the macro story and then ask the micro questions about, hey, what will a company need to succeed in this big market? One final point, I talked about how sometimes telling a story can let you check whether a valuation is internally consistent. Because we can't, there's no point disagreeing with somebody else's growth rate. That's their view. But you can look at a valuation and say, this valuation is at war with itself. So I'll give you an example, and this is from, 8, 9, 10 years ago, 2013. At that time, I'd valued Tesla on my blog. I came up with, at that time, Tesla was a tiny company, luxury auto company. Came up with a value like $150 per share, which at that time was, in fact, I thought, an extraordinarily optimistic valuation. But Tesla, through its history, has had the good fortune or the bad fortune, depending on how you look at it, or being followed by equity research analysts who are true believers in the company. So this is actually from an equity research report in 2013, where the equity research analyst had put a buy recommendation on Tesla and valued it at 4 times the current price. So I started looking at the numbers to see why his valuation was so different from mine. So I took a look at the number of cars sold. And at the time that we did the valuation, Tesla was selling 24,000 cars. It was a tiny company. He projected that it would grow to 1.1 million. Let me pause on that. Is that a plausible assumption? Sure, it's a big market, 80 million. Assuming you can sell 1.1 million cars, completely plausible. So I said, okay. In fact, in my valuation, I had assumed 900,000 or a million cars. So we were pretty close in terms of number of cars sold. Then I said, maybe he's assuming much bigger profit margins than me, because that could be the other explanation for the higher. So I looked at his margins, and his projected margins were actually a little lower than mine. He was projecting 8–10% margins, high-end automobile margins, but not super high. Now I'm completely befuddled. His revenues are close to mine. His margins are actually a little lower than mine. And so why is he getting 4 times the value? So I keep going down. And one of the simplest tests you can run of how much an analyst is projecting his reinvestment, rather than get distracted by the dozens of line items, take his estimate or her estimate of what the after-tax income is. What he called net income is actually this variant of after-tax income, and what is free cash flows. That difference between what you have as income and free cash flow is basically reinvestment. You can slice it and dice it as much as you want, but if those numbers are the same, you're not reinvesting. If those numbers are different, then you're reinvesting more. I added up the income the analyst was projecting over the next 15 years. Added up the cash flows over the next 15 years, compared the numbers, and there was almost no reinvestment happening over the next 10 years. So don't get thrown off by the CapEx. It's a net CapEx and working capital collectively put together, basically. So let's get this straight. You have 24,000 cars being sold now. You expect the company to sell 1.1 million. I'm with you so far. But in 2013, Tesla had 1 plant in Fremont with a capacity on a really good day of about 250,000 cars. But you're projecting 1.1 million cars. And if you're not putting in reinvestment, where are those cars going to be made? I actually knew the analyst mildly from some previous interaction. So I called him. He was actually in an airport. He was flying to California to visit Tesla, maybe to pray at a shrine to Elon Musk or something. And I said, I've been looking at your valuation. I have some questions. He said, I can't answer those questions. I said, why not? He said, well, I don't actually work on the numbers. I have a team that does that. If you want to ask questions, you should talk to the team. I said, when will you be back? He said, about a week. I said, can I call you? And he said, sure. And he said, before I hung up, he said, you're not going to write about this on your blog or anything, right? I said, not for the moment, but after the next week, all bets are off. So I called him a week later, his entire team, 7 people gathered around him. So he gets on and he says, look, I don't work with the numbers. I said, what do you do? He described it differently, but he seemed to schmooze a lot. He schmoozed with the top management. He schmoozed with people. He basically talked to. Then the second in command comes on. He said, I don't work with the numbers either. So what do you do? He says, I am the secondary schmoozer. When he schmoozes, I go, then there's a backup schmoozer and a backup to the backup schmoozer. And I said, who in this group actually works with the numbers? They pull up this young 23-year-old analyst they hired out of Wharton the previous year. He's the guy. I'm feeling really sorry for this guy, right? He's put on the spot. But he's a smart kid. I take him through the process, and after we get to that reinvestment part, he realizes there's a problem. I said, what happened? He said, it slipped my mind. I said, what slipped your mind? He said, basically, I took CapEx and depreciation the most recent year. The most recent year, they hadn't had much net CapEx. And then I projected the 2 numbers out. And because they grew at the same rate, basically, I was not building in reinvestment. And I said, do you think this is a problem that you're assuming you can sell 1.1 million cars and you have no capacity to make more than 200,000 cars? He said, clearly. Then he said, well, no, but we can't go public with it. It won't look good. I almost told him, I'll go public for you and it'll still not look good. But he said, what should I do? And I gave him a suggestion, which he did not take. I said, have you ever watched Willy Wonka's Chocolate Factory? Have you ever watched that movie, the old one with Gene Wilder? One of my favorite movies. One of the things that puzzled me when I first watched that movie, this is a strange thing to be puzzled about when you watch a movie, is one factory. Willy Wonka is one factory. There are Willy Wonka chocolates all over the world. My question was, how does this one factory have the capacity to make this many chocolates? And the answer is actually in the movie. If you ever watch the movie, there are these magical creatures called Oompa Loompas. If you don't know what they look like, go on Google, type in Oompa Loompas. There's tiny creatures that dance around. As they dance, chocolates come flying out of the factory. You don't need machines. Capacity constraints are removed. I said, here's what you need to do. Put out a news release that Elon Musk has fired his entire Fremont labor force and replaced them with Oompa Loompas. There's no capacity constraint. You can produce 10 million cars. Whenever you see a valuation with huge ambitions, it's not the ambition that I have a problem with. It's that you need to invest enough money to get that ambition into practice. And if you're asking, how can you miss something like this? The answer is very simple. People build spreadsheets. In a spreadsheet, what do? You take last year's numbers, you project each line item out. Nobody's looking at the collection of numbers. Say, what story am I telling about this company? And is that story defensible? You don't need me to actually review your spreadsheet. You have the capacity already, right? You're telling me a story. What I want you to think about is what that story is and whether you're okay with it. If you're okay with that story, I'm okay with that story. Because who am I to say that story is not right, that can't work? But I can tell you when your story is at war with itself, because that's a problem you need to fix if you want the story to actually come through. So with that extended introduction to stories, I'm now ready to convert my stories to numbers. Remember, I described valuation as a craft. You're saying, how do I convert my story into numbers? The first time you do it, it'll feel like you're just making up stuff. Just go along with that, because you are making up stuff. But the more you do it, the more you'll recognize how to get enough perspective to make up at least reasonable stuff. So here's how my Uber story worked out in numbers. How did I describe Uber? Urban car service company, right? So the total market I looked at was the urban car service market in 2013. You know how difficult it was to figure out how big that market was? Because the market was completely disorganized and splintered. Because for the most part around the world, pre-ride sharing, who provided urban car service? Taxi cabs. Most of them are not publicly traded companies, they're privately owned. There was no place I could go to get a size of that market. So here's what I had to do. I had to go city by city. I was able to do this for about 15 of the top 20 cities. New York, for instance, is a taxi and limousine commission. They're the ones who've regulated the cab business now for the last century, last 50, 60 years. They actually have an estimate of how much cabs make as revenues, because cabs are required to report to them all these basic statistics. So basically, I went market by market, adding up the cab service business. And I was able to get that for about the 15 big. So I came up with like 40 or 50 billion for the 15 biggest cities. And then I essentially looked at the rest of the world where I had no information. I said, must be much bigger. The 100 million is a lot of fuzzy stuff happening on top of my estimates. But that's what I started with as my estimate of the size of the urban car service market. To show you how you should never trust what you find online. Because about a year later, I was valuing Uber again. And I said, you know what? Let's see if somebody's come up with a better estimate of the size of the urban car service market. So I go into Google search and I say, size of the urban car service market. You know what shows up as the first find? 100 billion. And then it sources me. I said, if only you knew how little went into this number, you wouldn't be reporting it. So I'm saying, don't trust everything you see as market size out there for your market, because many of these markets, especially if they're unorganized, it's difficult. It's easier when you have an organized market. Like Tesla, it was much easier. Why? Because the bulk of the automobile market comes from public companies. They have revenues, so I can add up the revenues across companies and get a sense of the market. Much more difficult if you're looking at something like car service. So 600. Remember the second part of my story, I said it'll attract new people into the market. If you look at just the traditional car service market coming into 2013, it was growing at about 1.5 to 2% a year. But if you're able to attract more people in, that growth rate should be much higher. Again, it's a concocted number. It's higher than 2%. Why 6%? Well, basically, it's not. You're attracting young people, people who never take cabs. So 1.5% goes to 6%. I've brought in new people. I did describe Uber as having local networking benefits, right? What does that mean? In my story, you can have 10 different ride-sharing companies, even 15 different ride-sharing companies controlling different parts of the world, different cities. How does that play out? The market share that I gave Uber was 10% of the global car service business, which is huge relative to the typical market share you were seeing at companies then. But it wasn't 30 or 40% because my story is a local networking benefit story. Now, at each point, you say, I would have used a different story. Of course you would have. And it's shown up as a different number. I did assume that Uber can continue to do what they're doing, which is not own the cars and not hire the drivers. How does that play out? Because they really don't have any traditional operating expenses in steady state, whenever that comes about, Uber should be able to keep a hefty portion of their revenues as margins. They're an intermediary business. So the operating margins I gave them were 40% higher than what I'd give a taxi cab owner. You know why, right? A taxi cab owner has to buy a car, maintain the car, have the expenses, have the drivers as employees. 40% margins. And finally, because they don't own the cars, the way I showed that is the sales to capital ratio of 5, which means for every dollar of capital they invest, they get $5 of revenues because it costs Uber almost nothing to grow. I remember when Uber started in Delhi, they hired a guy, one guy, put him in a hotel room. They didn't want to pay for an office and told him to go sign up drivers. There's Delhi added on to the list. Doesn't mean you don't invest in anything, but you can grow with far less investment. Now you're saying, what about the cost of capital? You know what? I thought about the cost of capital in the last 5 minutes of my valuation. And the reason is simple. When you're valuing a young company, the cost of capital is not even on your top 10 list of things you worry about, right? You're saying, did you come up with a beta and a synthetic rating? I ignored everything I've told you about cost of capital. What I did was I have a histogram of cost of capital of all companies globally in the US. I went to the 90th percentile. And I said, you know what? I think Uber is a risky business. I'm going to give them a risky company's cost of capital. Because let's face it, playing this game of betas and risk-free rates and risk premiums, cost of equity and cost of debt kind of gets you pretty close to the same number, but it doesn't matter that much in this valuation. If you have 11.64%, it's about 12% cost of capital. Final piece of the puzzle, it's still a young money-losing company. A lot of regulatory challenges, lawsuits. There is a chance, at least in 2013, that the company will not make it. I gave a 10% chance it would not make it. Why so low? Because in a sense, it's too big to fail, right? You know what I mean by too big to fail? When venture capitalists have priced something at 17 billion, they have an incentive to keep you going. Otherwise, they have to write the whole thing off. So in a strange way, if this had been a $1.5 billion company rather than a 17 billion, the chance of failure might have been 20%. If it had been 150 million, it might be 40%. Yeah.
But if you use that same logic
on what? Yeah.
Like it was also.
I agree. So in fact, what you saw in Theranos and WeWork is the exception. That's why we make movies out of them, right? That's why you very seldom see big companies crash and burn. Something truly catastrophic has to happen. With Theranos, it's the fact that they broke the law that killed them. Because otherwise, the VCs would have found some way of song and dance of saying, this is all okay, we're going to get approved. Once it was discovered that they'd been cooking the lab test, they were done. There was no coming back from that. With WeWork, again, it was a corporate governance that ultimately killed them. Because nobody could stand up with a straight face and this is all going to be okay. So I think they remain the exceptions. Very few big companies crash and burn. They leak away over time, right? but it's very seldom that you see a $30 billion young startup go to zero.
But
Because
Uber at least had stuff through business model.
you need some proof. So basically, if Uber was still an idea company and said, well, this is what, that 10% would have been closer to 40 or 50%, right? So by the time you get to 2013, we knew ride sharing was working. We knew it had worked really well in the Bay Area. And the Bay Area is not exactly the prototype for the rest of the world. So you got to be careful about extrapolating what happens in Northern California to any other, or Southern California, any part of California to the rest of the world. But clearly there was proof that this process worked. There were still things that, in fact, I said, look, I think they will grow. My question with Uber was, can they figure out how to make money? You know what? 9 years later, it's exactly the same question I still have for Uber. They figured out how to grow. They've cracked the code on that. The money making, not so much. So I've got my story convert to numbers. Once I've come with that, the valuation kind of does itself, right? I've got revenue growth, I've got margins, the rest is pure mechanics. I could probably mechanize the process. If you tell me a story and give me the inputs, valuation. In fact, that's what the FCF of Ginzu's spreadsheet is. It's really not a spreadsheet to value companies. It's a spreadsheet to make your story into a valuation. So with my story, and I want to emphasize my story, it's not the story for Uber. The value that I came up with for Uber, with my story, with my cost of capital, was about $6 billion. What was the story that triggered my interest in Uber? A Wall Street Journal story that VCs had priced the company at 17 billion, right? So I finished this valuation. I posted on my blog, I think at 3:15 on a Friday afternoon. I'm not kidding. 15 minutes later, I get a call from a Wall Street Journal reporter. I don't know what she was doing, just waiting for the post to come out. She said, I noticed you valued Uber on your blog. I said, thank you for noticing. She said, I noticed you attached a value of 6 billion. I said, you're very observant. And she said, VCs have valued the company at 17 billion. I almost corrected her there. With what? That VCs don't value companies. But she's a reporter. I cut her some slack. I said, you know what? Yeah, I do know that. She said, how do you explain the 17 billion? I said, I don't have to. I didn't pay it. I've never felt the urge to explain what other people pay. I don't have to explain what Masa Son paid. Masa Son has to explain what he paid for SoftBank. You know how much frustration this is going to save you in your life, not trying to explain what other people pay? Why are people paying 45,000 for Bitcoin? Go ask somebody who paid 45,000. Why are you asking me? Why are people paying thousands of dollars for bored monkeys? I have no idea. Go ask somebody who's paying for thousands of dollars. You have no idea what I'm talking about, right? You heard about the bored monkey NFTs? This is peak craziness. Okay? You're paying, thousands of dollars for a bored-looking monkey. I can get you a bored-looking monkey from the San Diego Zoo for a lot less money, the real monkey, and he'll be bored sitting around your house because you have nothing to do. And at least you have something tangible in front of you, not a virtual bored monkey. And she said, are you telling me they're wrong? I said, I'm telling you nothing of the sort. I'm saying with my story, I can't get to 17 billion. Maybe you need to ask them what their story is. That's really what I would argue for. Don't tell somebody that they're crazy for paying 30 billion. I would tell somebody who's paying $3,000 for a bored monkey, you're crazy. But if you're paying 3 billion for a company, I'm not going to rule out the possibility that you have a much bigger story than mine. What's that story? Yes.
Like narrative pricing feedback.
Yeah.
Why is it not great when it goes public?
Because when you're a public investor investing in a young company, what's the number you start with? Because remember, you don't have, when you invest in a public company, you usually start with the market price because somebody else has set the price, and that becomes your frame of reference. But when a company goes public, what do you look at? You look at what the VCs last priced the company at, right? So when we were going public, the first thing people checked out, VCs priced it at 47 billion. Then you look at the name of the VC, it's SoftBank, it's Masa Son. And whether this is right or not, your mind goes, well, if he paid 47 billion and he knows a lot more than I do, then it must be worth more than 47 billion. It's pricing. And here the pricing is being set by the VCs. The cycle eventually breaks. And it happens when companies hit that bar mitzvah moment, right? When market said, this is all nice, but when are you going to start making money? And that might take 2 years, 4 years, 5 years. But when it does happen, you better be ready as a company, right? Because Twitter's had that moment multiple times in the last 8 years and failed every single time. So if you're a founder, I know you got to cater to VCs. They want you to increase users, you got to increase, but you almost have to be working in a parallel path of building a business story that actually makes sense. So I think eventually the cycle breaks, but by then a lot of people have made money and moved on. They're going to be celebrated as successful investors. Remember, if Kathy Wood had liquidated her positions towards the end of last year or the middle of last year at the peak, people will be viewing her as an amazing, even though every company she invested in goes to now a fraction of its price, she'd be celebrated as a great investor, when in fact, she basically got the mood and the momentum right. VCs are judged not based on the quality of the companies they buy, but based on timing. When did they get in? When did they get out? Take Mark Cuban, right? We all think of him as a great VC. What was a company that Mark created that's at the source of the legend here? What made him, climb the ranks of the company? Does anybody remember? It's a company called broadcast.com that he started in the late 90s. I don't even remember what the company did, something. He sold it to, I think, Yahoo at the peak of the dot-com boom for $5 billion. You know what happened to broadcast.com? It went bankrupt in 2001. If I judge Mark Cuban on the quality of the company he built, clearly he's not a great VC. But if you judge him on did he make money, of course he got out at the right time at $5 billion. The VC business is about timing. If you can get in and get out at the right time, who cares? I mean, at least the way people judge VCs, you're not judged on the quality of the companies you build. You're judged on when you get in and when you get out. It's a trading skill. So when you look at the 6 billion, that is not the valuation of Uber, that is my valuation of Uber. So I actually posted this on my blog. And I got lucky because after I posted it, I got multiple services ask me, can we post this as well? The first site that reached out to me was a site called 538.com. You heard of 538? Nate Silver, the New York Times, used to work at the New York Times. It's a geek site, numbers geek site. Basically, they take everything, sports, politics, and they apply statistics and number crunching to it. They said, our readers care about numbers, they're number crunching geeks, they like this. And I said, sure. The second site that called me was the Forbes blog. Who reads the Forbes blog? 70-year-olds with flip phones, I think, very old-time value investors. And they said, our investors have always wondered about why people are crazy and pay for these young tech companies. They would love, I said, go ahead. The third site that called me was a site called the Ride Sharing Guide. It's still around. If you get a chance, a guy called Harry Campbell runs the site. It's a site dedicated to Uber and Lyft drivers. Say, how many of them can there be? Do you know how many people drove for Uber last year? Or at least before COVID? 3 million people. That's a big market. So he writes for drivers and people he said, we'd love to carry this because our Uber drivers might be interested in this. So it gets posted. Exactly the same post with exactly the same story and valuations. I get very different sets of reactions. It's called a feedback loop. So on the 538 site, read by number crunchers, here's the kind of question I get. I noticed you used a 12% cost of capital, but I looked at, because I'd put up the percentiles and the deciles that I had and you said you used the 90th percent, but the 90th percent had a cost of capital of 11.91%. How come you used 12%? This is what number geeks get caught up on, right? Why? And I said, it's an open spreadsheet. Why don't you change the 12% to 11.91% and see what happens? 5 minutes later, I get an email saying, I see why you left it at 12%. Nothing to be learned from nitpicking feedback. The Forbes site, they loved it. They said, this is the way people should be thinking. I'd even waste my time on the site because all they do is pat you on the back and say how great you are. Nothing is going to come out of this. Oh, I forgot to mention, there was a fourth site called Techcrunch that also picked it. Have you heard of Techcrunch? It's really this inside tech digital publication, read primarily by tech geeks. They absolutely hated it. Their reaction was, how dare you value one of ours with your D.C.F models? We don't allow that here. So there are, I think, 300 comments on the post. Half were pure insults, most of which I didn't even understand. One just said, you DCF guy. That's it. That was a whole comment. So, okay, what is that supposed to mean? You crazy New Yorker. I'm not even a New Yorker native, a native New Yorker. But then there were comments that started with an insult. You idiot. Let me tell you how the ride-sharing business works. You know what? I'm glad I read through them because I understood about how the networking benefit worked, how Uber collected data, how they decided how to do surge pricing. I'm not a tech guy. I'm not from the ride-sharing business. And then on the ride-sharing side, I heard from Uber drivers. And I heard some fascinating things about Uber's business. Remember that I assumed that Uber gets to keep 20% of the fare? That's what they tell everybody. A driver, an Uber driver from LA, emails me and he says, Uber's going around telling the world that they keep 20% of the fare. But that's not true. He said, in LA, here's what's happening. I used to drive for Lyft until 2 months ago. Uber paid me $5,000 to switch to them. Lyft is now offering to pay me $7,500 to switch back. This is like being a free agent without a contract. By the time they do all of the spending, I'd be surprised if they kept more than 7 or 8% of the fare. You know what? 5 years later, Uber leaks out that their contribution margin in the big cities is about 7 to 8%. I almost texted them and said, I know this already. An Uber driver in LA told me. The feedback loop basically means keeping yourself open to people who disagree with you. One of our problems is we live in a world where we're surrounded by people who think like we do. You go to work for a VC, you talk to other people who are VCs, you all tell yourself stories. Nobody has a number. You go to work for a bank, you're surrounded by bankers, you all talk about EBITDA multiples as if the world revolves around EBITDA multiples. There's no pushback because you're reading from the same script. Hang out with people who don't think like you. When I valued Airbnb, the first person I checked my valuation with, a friend of mine rents Airbnb properties in San Diego. I want to say, am I missing something? What is it in my story I need to think about? And in the case of Uber, it all came to fruition about 3 weeks after I posted. I was sitting, I think, in Munich airport waiting for a flight that was delayed. And I get on my phone and I start checking my emails. And I see an email from a guy called Bill Gurley. Heard of Bill? He's partner at Benchmark Capital. Benchmark Capital was a VC investor in Uber at a $1 billion pricing. And Bill actually sat on the board of directors for Uber in 2013. It was rumored to be the person closest to Travis Kalanick, who's the CEO of Uber. Let me start with a simple question. Does Bill know more about Uber than I do? Absolutely. So I opened the email because it's obviously Bill. And he said, I read your post on Uber and did not like it. I said, okay, we got that out of the way. He said, I've written my own post to counter yours. This is blog post to blog post warfare, very 21st century. And he said, I've taken issue with your assumptions and I've said some mean things about you. And I just wanted to let you know. Sincerely, Bill. I'm still sitting in Munich airport. I close his email. Like an hour and a half for my flight. Guess where I go next? I go to Bill Gurley's blog. It's called Above the Crowd. He's 6 feet 7 inches. He's a really tall guy, so above the crowd kind of fits. And he, I forget the exact name of the post. Missing, Demodrin misses by a mile or something. There was something to do with driving and missing. And essentially, he took issue with every part of my story. He said, you know what? Uber is not a car service company. It's a logistics company. Notice how words have consequences. When you describe yourself as a logistics business, you're in car service, you're in delivery, you're in moving, you've expanded the market. He said, Uber is not just urban, it's going to be everywhere. He gave examples of rural and suburban services Uber was planning to offer. And he said, I know right now we're talking about individual cities, but we're going to find a way to take our domination in New York and make a domination elsewhere, because we've got partnerships with airlines and with credit card companies who are going to allow us. Essentially, he was telling a global networking story. He thought I was going to be pissed off because he said these mean things, but he was telling a really, I was fascinated. So I'm still sitting in Munich airport. I emailed him and said, Bill, I love your story. Would you like me to put a number? Because he didn't mention a single number, the story. I said, would you like me to put a number in your story? He said, be my guest. So I took my spreadsheet and I changed two numbers. Remember the $10 billion, $100 billion total market I had, the urban car service market? If you bring in moving and delivery into the business, and those are actually easier businesses to see how big the market is because it's more organized, that market becomes 3 times larger, $300 billion total market. And remember the 10% market share I gave them with local networking benefits? If this story about being able to go global works, in Bill's story, there are going to be only 2 or 3 ride-sharing companies that dominate the world. The market share is going to be much higher. I gave them a 40% market share. With those changes put in, the value that I got for Uber was $53 billion. I sent him the value and he said, oh, by the way, I should tell you that this 20% market share is not long for the world. We don't make 20. I said, I almost told him, I know this already. Your Uber driver in LA told me. I said, that's easy to fix. I took my spreadsheet because the 20% was an input and made it 10% of the fare. Guess what? The value drops to 29 billion. You think, how can the same company be worth 6 billion, 29 billion, and 53 billion? Depends on how the story is framed. Doesn't mean every single one of these stories is a fair or plausible story, but you can see how you can get disagreements about value based on the story's frame. And if you're a founder, you see why words matter? In all of the years I saw Travis describe the company, in the early years, he was a spokesperson. He never once used the word car service to describe Uber. It's always transportation, logistics. It's deliberate because, essentially it means the market is much bigger. You know what Airbnb describes it as? A hospitality company. Bigger stories basically mean your market is bigger. It does create challenges along the way. In fact, if you think about contrasting stories, take a look at Uber versus Lyft. Lyft always went with a much narrower story. Early on, they said, we're car service, primarily US. Uber always had the higher pricing, but Lyft actually had a better time delivering the numbers that people expected to because they kept a story that was actually compact and deliverable. Uber constantly had distractions. Uber trucks, Uber moving, all these startups. Other than Uber Eats, nothing that Uber has done outside of car service has actually made the money. Uber trucks, lots of promise when it was never say. Uber moving, never got off the ground. One final thing that I did with the Uber post, you can see how I milked my post, like 4 posts come out of the same. In fact, one of the book I had a narrative and numbers was born out of that post on stories and numbers. Is I finally created do it yourself. And you've seen this play out with Tesla now, but the first time I ever did this with Uber, because I got sick and tired of people disagreeing with an input of mine. I said, you know what? This is my story. Make it yours. Pick your own story based on what you think about Uber's market. What you think. So basically, I let people pick. What do you think the market is? Is it a car service company, transportation company, a logistics company, a mobility? You pick your story. You pick the competitive advantage. You pick the fact whether it's local or global networking benefits. And I'll value the company for you. So essentially, I'll create the framework and you can change your story and you're going to see a value shift. And guess what? Based on the story, the company could be worth less than $1 billion or over 90 billion. Doesn't mean that all of these stories are fair stories. Some are clearly much more plausible than others, but you can see how stories can lead to very divergent values. One final point about stories. You're done with the story, you heave a sigh of relief. Don't get too comfortable. Because stories can not just change, sometimes they can break. What's an example of you invest in a young pharmaceutical company with this potential blockbuster drug working its way through the pipeline. You attach a value of billions, right? It's a drug to treat diabetes, it's a huge market. You attach a $10 billion value. But remember, the drug is still working its way through the pipeline. All you are is one news story away from the value going to zero, right? What's a new story? A new story that in the second stage of the test, that 3 people who took the drug developed serious side effects, and the FDA has asked them to suspend testing. Gone. It's a story break. You have a story built around a personality. The personality develops. I mean, remember, human beings have limited lifespans. A person drops dead, there goes the value of your company. Story breaks hopefully don't happen that often, but with young companies built around a person, it can happen. What's more common is either a story shift or a story change. What's a story shift? The contours of the story stay the same, but mild factors can change. Your growth could be a little higher, your margins can shift. For me, Apple has been one of these companies where I've told pretty much the same story for the last decade. The story is of a company, it's the greatest cash machine in history, but a slow growth cash machine built around a single product, the iPhone. And from 2012 through 2019, that story pretty much worked. It doesn't mean the value didn't change, but it didn't change dramatically because the core story stayed the same. I wasn't thrown off by the Apple Watch. I knew that this couldn't change the company's value one small bit. You know why? The Apple Watch by itself is like the watch business collectively is like a $50 billion business, the total business. Even if you get 100% market share, it's $50 billion. And you're a company with a $3 trillion market cap or a $2 trillion market cap, it could make enough of a difference. The one business that's shown up in the last 3 years that potentially could change Apple is Apple Services, which is all these devices now buy off the Apple service. And the Apple Services business is a great business to be in because everybody who sells through the App Store leaves a slice of their life in the store. In fact, they've sued because Apple takes so much of their. That's a story change, something happening to the story that could potentially make a company better. Anybody value Peloton? 3 years ago when it went public, the story that I've told for Peloton is very different from the story now, right? It's more of a subscriber-based story than an equipment-based company. So going forward, you can tell 2 stories, that it becomes entirely a subscriber-based company, which could happen, right? You got a new CEO who says, why are we making all this expensive equipment with the logistical and the manufacturing issues? Let's make it a subscription-based model. Doesn't mean it doesn't come upside and downside. Or you could say, look, we're going to go back to our basics. We're going to go back to making equipment. Now, 2 very divergent stories with very divergent valuations. In fact, COVID was, I think, kind of a shifter for many stories. Zoom went from being this business meeting app to being an app that basically could be for education, for meetings, for Friday night hanging together. I mean, it's kind of sad that we're at that stage, but you can see how the company shifted. So I would pick one of these companies that benefited from COVID and then kind of given it all back and ask the question, what does the story look like now versus what it looked like 3 years ago? Stories change. So any questions on storytelling? To me, this is what makes valuation fun. If all you did was work with spreadsheets, I wouldn't be teaching this class. I'd be bored out of my wits. I'd be gone. Okay? To me, what makes valuations fascinating is the story under the numbers and how that story changes because it makes it a constantly shifting game. Notice up till now, I haven't valued a single company all the way through. Until Uber, in fact. Now, I've talked about pieces of companies, growth rate. So now I'm going to change that because starting now going through the next 2 sessions, I'm going to value company after company. But because we've done the groundwork, I'm not going to be spending time talking about what a free cash flow to the firm is or what a cost of capital is. I'm going to talk about the story with each company and how it plays out in the numbers. So as we go through these company valuations, I'm going to save myself a little trouble. Some of these valuations are 12 years old, some are 7 years old, some are 3 years old, some are even 20 years old. There's an Amazon valuation, 2001. In every valuation, I need an equity risk premium, right? You're going to see that number shift over time. And I'm going to tell you how it's going to shift. It's based on my implied premiums over time. So as I go from 2001 to 2006, 2009 to 2012 to 2022, you're going to see my equity risk premium shift. And you're wondering, where do those numbers come from? They come from my implied equity risk premium calculations at that point in time. Right now, post-Russian crisis, the implied equity risk premium for the US is moving towards 5%. So every company I might value in April, you're going to see a 5% equity risk premium. Could that change? Absolutely. It could go up or down depending on what happens in the market over time. So with that structure, let's talk about how each valuation is going to be structured. With each company, I'm going to start with the kind of story I tell about the company. In some of these companies, the stories kind of doesn't add much because it's a mature company. This numbers kind of tell the same story. But then I'm going to focus on each valuation with one piece of the valuation that I think makes it different from the rest. Otherwise, you're going to be looking at the same thing play out over and over again. So let's start easy. Let's start with an easy company to value before we get all ambitious. So the company I'm going to value is Con Ed. What is Con Ed? It's the utility that delivers power in this room. It's the electric utility that serves New York City and the environment. In the US, for the most part, power companies are regulated. Regulated in what sense? They're regulated monopolies. Now, if you are in New York, you can buy power only from Con Ed. I mean, a few parts of the country that's starting to open up, but it's a regulated monopoly. Now, normally, if you're a monopoly, what do you get? You get pricing power. But the fact that you're a regulated monopoly means you don't have pricing power. For Con Ed, the only way you can raise a rate is you got to go in front of a state regulatory commission. And the regulatory commission tells you whether you can raise your rate or not. You know what they look at? This is true across the country. It's almost in the law. How do regulatory commissions decide whether you can raise rates or not? What do they look at? They look at your return on equity. And so the only place where academic finance actually has an impact, because if you're earning a return on equity that is less than your cost of equity, you go to the regulatory commission and say, I am not making enough money to cover my risk. I need to raise prices. If you're making a return of equity of 20%, you're not going to get a price rise for the next few years, which creates a lot of game playing. If you're a regulated utility, here's what you're going to tell the regulators. Our cost of equity is 20%. And you get an expert to come in and testify that your beta is 6 and your risk premium is 15%. And there's always an expert who will say anything that you want them to say. And then you claim your return equity is 3%, and you might be cooking the books, or you can't really commit fraud, but you can get discretionary expenses move forward. But this is a dance across the country to the regulators. But because you're a regulated utility, a couple of things come out. One is because you're not allowed to go to other businesses. That's the other thing about being a regulated monopoly is you can't say, I want to be a green energy company. I want to be a tech company. You're basically going to have to be in this business. You're going to be a mature company if you're a New York-based power utility. Why? Because the population is not growing that much. It might be different if you're in the mountain states, right, where growth is and people are moving. You might have it. But here, if you're looking at a regulated monopoly, it's going to be a stable growth firm. And this is also one of the few businesses where companies pay out almost everything they can afford to in dividends. In other words, one of the few businesses where dividends tend to be roughly equal to free cash flow equity because the kinds of investors who invest in utilities want the dividend. So here's what I did. I started by testing out those propositions. I said, is this company, a stable company? It's paying out dividends like a mature company. In what sense? It's paying out almost 70, 75% of its earnings as dividends. Growth companies don't do that. So on that test, it looks like a mature company. It's paying out big dividends. I then asked, what kind of growth rate can I expect this company to have? Its return on equity was about 7.7%. That's what you get from looking at the net income and book equity. And if you're paying out 73% of your earnings as dividends, your retention ratio is 23%, your expected growth rate is, so they're paying out companies like paying out dividends like a mature company. Their growth rate is a growth rate that I can live with as a growth rate forever. How do I know? Well, that growth rate was lower than my risk-free rate by far. So it's a growth rate that I can use as my growth rate forever. I valued Con Ed with a stable growth dividend discount model. But I'm saying, if any of you decide to go with the stable growth model, check the numbers, kick the tires first, right? You don't want to just impose a stable growth model because it's an easy model to work with. Make sure your company is low growth. Make sure it's behaving like a low growth company. It's either paying lots in dividends, it's not reinvesting very much. And if the facts align, then you can say, you know what? I don't have to have 10 years of growth. So to value the company, here's what I did. I estimated the expected dividends next year and divided by the cost of equity. Cost of equity is based on looking at bottom-up beta. So essentially the cost of equity, the beta, the growth rate are those of a mature company. The value per share I got by using an dividend discount model was $42.30. The stock was actually trading at $40.76 when I did this. So what's my conclusion? It's very mildly undervalued. Very mildly. Why? Because small changes in my assumptions can get me to 47.6. In fact, one of the questions you can ask is, what would my growth rate need to be to get my value equal to the price? It has to be like 2% instead of 2.1%. So we're talking about numbers that are so close that you cannot reject the hypothesis that it's a fairly valued company. That was easy, right? You're saying, why didn't I pick a regulated utility? My valuation would be done already. How much are you going to learn from doing this? And why would you need to come to a class and take this class and torture yourself on free cash flow as a firm if all you're going to value is Con Ed over and over again? But a stable growth dividend discount model is a good starting point to think about valuation. Okay? This is called a break-even growth rate. In your valuation, you can actually solve for it. The revenue growth, for instance, tell me what revenue growth I would need in my company to get a value equal to the price. It's a great exercise in seeing how much buffer you have in your assumptions. So let's stop there. When we continue next, we're going to start by valuing the S&P 500 and then value a bunch of companies, again, using the same mechanics.